It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, yourpersonalbank.com. So for the last several weeks, I've been discussing the extreme valuations in the stock market, the S&P 500, etc. For those of you who might be a little tired of it, I apologize, but it's such a significant development. This is historical, like all time ever recorded in the history of the stock market. State this is the highest levels by far, even including 1929 and 1999. And until people really understand how overvalued, how extended this current market is, and how much risk there really is involved, I'm going to have to keep sharing this information. Please understand, I am an optimist at heart. I don't like sharing negative information, but I also at the same time cannot ignore the facts in front of me. And to give you an example, the market has never, ever been this overvalued. There's four major valuation indicators. There's the Crestmont PE, cyclical PE, E10, the Q ratio, and S&P regression. These are four major valuation indicators, are all overvalued by 3 standard deviations. Indicators average 178%, which is the highest ever. Put this in perspective, the dot-com peak in 2000 was 125%. So we're more than 50% higher from a valuation standpoint. We're over 50% higher asset valuations than we were at the peak of the 2000 dot-com bubble. These are levels that are so extreme, again, never been recorded before. And to add an additional cause of risk is the extreme concentration of this high valuations. Turns out the top 10 U.S. stocks now account for over 41% of the S&P 500's total market cap. And AI-related stocks themselves make up 47% of the S&P 500's total value. So approximately half of the entire value of the S&P 500 is now wrapped up in the AI bubble or the AI hype, whatever you want to call it. The argument that's made that we're not in a bubble is often that, unlike in the dot-com era, the companies that are leading the charge are profitable companies. Well, that argument, for one, is not entirely true. There were a number of companies in the dot-com era that were profitable, Cisco being one of the leading ones that was a very, very profitable company leading into the dot-com bubble and then burst. Their stock dropped over 80%, despite the fact that they were a highly profitable company. So I don't think, in my opinion, that argument really holds water if we see a correction or even a crash. Another troubling fact is this. Although the 10 biggest names in the S&P 500 now account for over 44% of the value or the market cap share of the S&P 500, they only account for 34% of its income. This is especially troubling because a stock's value is supposed to be a reflection of its ability to earn or its earnings capabilities either now or in the future. The stock prices and valuations have run so far so fast that they've outpaced the earnings. And if you compare this to what's called the S&P 500 equal weighted, this is where it takes every company in the S&P 500 and it weighs them equally. The ratio is now the lowest it's been in 22 years. The last time we saw numbers this low in the remaining 490 companies of the S&P 500 was in the midst of the Great Recession, the 08-09 Great Recession. Further illustrates that this run-up is really just being driven by a handful of mega-cap tech names. And something else has happened that cannot be ignored. Many listeners understand this, but I was the chairman of the board of an FDIC-insured bank in formation. So I'm very familiar and understand the banking industry and still have some connections to that. And it turns out recently the Federal Reserve just pumped almost $30 billion into the U.S. banking system through what's called overnight repos. And this is used to keep liquidity in banks so that they stay solvent. Banks are required each day to balance their books, and they have to have a certain percentage of assets and liabilities, and they have to have a certain percentage of reserves to stay solvent. Bank regulators require this. FDIC requires this. And why this almost $30 billion pumped into the system literally overnight is this far surpasses even the peak of the dot-com bubble. We never saw in the dot-com bubble where the Federal Reserve pumped this much money into the banks. They pumped money into the banks during that time, obviously to keep them viable and solvent, but we've never seen it at this levels. Why is the Fed doing that? They just don't pump money into banks willy-nilly or for no reason whatsoever. Now, I can't say for sure what the reason is because I don't know, but this is a major red flag that the banking sector is facing some real financial stress. Now, I do want to go back to this point about the argument that this time is different because in the dot-com bubble, the companies weren't profitable. Well, that, again, is not true at all. Cisco being a perfect example of a very profitable company that got creamed, lost about 80% of its stock value in the dot-com bust, even though it was a very profitable company at the time. It was profitable, but its stock price got way ahead of its skis. And if you look at the charts today, where you see the peak of Cisco in 2000 versus where NVIDIA is now in 2025, the Cisco numbers look like a pimple in comparison versus the numbers with NVIDIA. And I guess the real thing to understand is this. The market is being dragged up by about 10 companies. Many of them are all round-tripping revenue. They're making deals with each other, making outlandish claims of future earnings, while currently producing little or none in real life, in terms of AI, that is. They're actively coordinating public relation messages and cross-sells to each other, continue to push the bubble up. See, I saw the dot-com bubble. I was in the industry. This is my 26th year. My first year or so when I saw what happened then. So this really looks like deja vu. I truly didn't believe I would see something like this again. Yet not only am I seeing again and experiencing it again, we're seeing it on a factor, a multiplier, even bigger than the dot-com bubble. It's really shocking to witness. And it is extreme. This is extremely dangerous. But let's play devil's advocate for a minute. And let's take the claims of the AI companies and these big tech companies at face values. Even if these companies could manage to get the profitability based on their price, their valuations, etc., where they are right now, you couldn't justify that price to earnings for at least a decade, if not longer. The energy infrastructure, we've discussed this on the show many times, is not in place to provide for the data centers to even get remotely close to the earnings these companies have claimed. Now, I've heard some discussion, to be fair, from the Trump administration that they are fast-tracking approvals for these companies to create their own electricity. It remains to be seen whether they can develop these electrical plants quick enough to provide the power needed to run these data centers so that AI can then progress to the next level as they want it to or they're promising us to. But again, taking their claims on their face value, and AI does magically transform our society, well, that means it's going to take a lot of jobs away. And it's also going to require much, much more energy, which will very likely increase our energy prices significantly. So that puts us kind of in a catch-22. There's a double bind really going on, whereas this article points out, we're screwed whether the tech succeeds or fails. This is what they mean by that. Either the bubble is going to burst and wipes out a huge sector of the economy, and we'll see a tremendous correction in the market, unlike probably anyone alive has ever seen, or AI replaces human workers across industries, and we will see a tremendous recession-level event because of lack of jobs. Neither of those options are particularly appealing, in terms from an economic standpoint, that is. What it really boils down to is whether AI works out or not, we have a lot of volatility ahead of us. And I think that's the one thing that everyone, or nearly everyone, can agree with. given that it's most likely that we will see volatility, probably even extreme volatility ahead of us, we could see a significant correction, even a crash that could be quite aggressive, quite hard, whether it comes from AI failing to meet expectations, either in its ability or time frames, or it does succeed and starts taking jobs away at a rapid rate, which would increase unemployment significantly, which obviously would be bad for the economy. How do you protect yourself from your investments, your assets, your nest egg that you've been building, many of you for your entire adult lifetime? How do you protect your retirement, whether you are retired or building towards it? Well, what the professionals do is when risk is elevated, you scale back. You peel back the risk. You put some of the money into something that's safe, that can grow. And index products, annuities, life, can accomplish that. They have the ability to earn unlimited upside gains with no downside risk. The principal is guaranteed. And when the gains, whatever they may be, are locked in, you get to keep those gains. But it even goes further than that. This is what's really cool about this, and some people ask the question, which is very valid. What if I get into this and the market corrects? I wouldn't make any money that year. That is correct. But the good news is you wouldn't lose either. But it even gets better than that. Let me use a simple example. Let's say you put $100,000 into an index product, annuity, life, whatever, and it goes up 10% in a year. So obviously you'd have $110,000 a year later. And then let's assume the following year the market corrects, drops, crashes, whatever. Doesn't matter. The principal is guaranteed. You locked in that gain and you have $110,000 still. The following year, though, the index dropped. The market dropped in value, right? You get to reset at the lower index level, and your growth is based on that lower index number going forward. You have the bigger amount of money, in our example, 100,000 to 110, because you made 10%. So your 110 can grow forward at a lower index starting point, which means you can capture much of that recovery after the crash or correction occurs. I'm going to tell you another differentiator. You know, there's over 600 indexes out there with over 50 companies that offer these types of products. I have access to most all of them, including all the top carriers. And when you have over 600 options and indexes, how does an advisor, an agent know which one to pick? Well, you can make some educated guesses, but we have proprietary software that very few advisors or agents have access to, where we have the 1, 5, 10-year results of what they've actually produced. And there's a wide range, folks. We got indexes that have averaged close to zero over the last decade, and others have averaged up to 17% average annual return over the past decade. Well, by having access to the actual returns, it helps us make a far greater educated choice in terms of what indexes are most likely to produce in the future. Without that information, frankly, you're just flying blind. I was, for quite some time, as an agent, looking at these things and making recommendations until I obtained access to this proprietary information. And folks, it's been a game changer. So much so, I have a client that literally a couple of weeks ago, he had an index annuity he obtained from another agent. My client was the wife. She obtained one from me. They got married recently. His return last year was just over 1%, and hers was 18.5%. In the same household, roughly the same time frame. Obviously, he was not happy with that return, and I showed him why. He had the wrong indexes, folks, plain and simple. In fact, none of his indexes had ever averaged more than 5% annually over the past decade. So he was highly unlikely to get much greater returns of that, and many of my clients doing annual reviews year to date have been obtaining 16 to 22% returns because we're picking the better indexes, the ones that are more likely to get greater upside potential returns. If you want more information on this, please contact me at yourpersonalbank.com. Stay tuned in the next segment. I got some more information on this and why when an index annuity might be the better choice versus an indexed life product or a fixed life product. So stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
I'm Ferenc Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. I saw this article that I thought was really powerful, and the title is AI is the Bubble to Burst Them All. And the point of the article is they talked to a number of scholars who literally wrote books on tech bubbles, and they applied the test in these scholarly books, etc., on what is a bubble versus what is not a bubble to today's current AI stock valuation. And the point they're making here is AI may not simply be a bubble or even an enormous bubble. It may be the ultimate bubble. They're pointing out this could be the one bubble to burst them all. The things that cause bubbles to occur, there's several different factors. And one of those, and this again these are from a number of scholars looking at previous bubbles throughout history. And one of those key points is uncertainty. There's no question that uncertainty exists in the current tech bubble. No one really knows yet if AI is going to produce the promise of fundamentally changing our economy. You have major players investing heavily into data centers, infrastructure, and etc., to help AI move to the next level, the next tier. All have agreed it'll take an enormous amount of power, predominantly electricity and computing power, to get AI to the next level, to even give it a chance to accomplish what many have been promising now for several years. The problem we face with the current bubble, as they point out in these scholarly studies, is usually over time, uncertainty goes down. Typically, when you have new technology, it becomes more and more apparent that the technology is going to make a fundamental difference. We saw that with the internet, for example. Initially, it wasn't known if it would fundamentally change the economy. It had the promise to do so, but as time progressed, it became more and more apparent that that was going to occur. Now, we had the crash, the dot-com bubble crash, because it ended up taking about a decade longer than the initial hype projected. But you can go back to any type of new revolutionary technology, whether it was computers or cars or railroads or electricity or any of those technologies that had a fundamental change. Most all of those, again, as time went forward, it became more and more obvious that this was going to be a significant positive change in the economy and society and all that. Unfortunately, what's happened in the current AI hype is in the last few months, it has become less certain that AI will be able to make the fundamental changes that have been promised. As these scholars point out, they think the market is still underestimating the difficulty of integrating AI into organizations, which means there is more likely to be in a bubble and then it burst. Another key factor of bubbles is pure play. And what is pure play? Well, they use the example as why is Toyota valued at over $270 billion while Tesla is worth over $1.5 trillion, yet Toyota shipped more cars than Tesla last year and brought in 3 times more revenue. And the answer is Tesla's status as a pure play investment in electric and, to a lesser extent, autonomous cars. It has more upside potential than Toyota does currently. So investors are willing to invest more into Tesla currently because of its greater upside potential. And it turns out, according to Silicon Valley Bank, 58% of all venture capital investment this past year has gone into AI companies. This is worrying, as they state, because it's an increasing concentration of venture capital moving into one area of the economy, which is another cause that a bubble is more likely to occur and burst. A third factor of bubbles that's consistent is novice investors. For example, in 2000, the stock market hit a milestone with the tech-heavy NASDAQ because hordes of novice retail investors were pumping money into these dot-com companies. We're seeing the same type of thing happening currently with AI, which increases the likelihood of a bubble. And as these scholars point out, everyone is something of a novice investor when it comes to AI because it's such a new field in technology and that there's so much uncertainty. Another condition of bubbles is coordination or alignment of beliefs through narratives. And what they mean by that, they use the example of when Charles Lindbergh flew the first nonstop transatlantic flight from New York to Paris. But the flight made news around the world. It was the biggest tech demo of the day, and it became an enormous launching event or a signal to investors to pour money into the industry. And it was obvious to pretty much anyone that the importance of airplanes and air travel was a big deal in the future. Unfortunately, that bubble burst because the market overestimated how quickly the industry would achieve technological viability and profitability. Was aviation stocks dropped 96% from 1929 to 1932. Now, I'm not saying that we're going to see those types of percentages again, but understand the motivation behind it is there's this coordination or alignment. Everyone believes this is going to happen. It may or may not work out, or as I point out, it may not work out in the time frame that the hype and what many people believe. And I've seen other articles where people working at many of these companies who have invested in AI and they're pushing their employees to use the AI despite the fact that it has a number of challenges, partly because of the belief they have in it that it's a good thing. They've invested a lot of money in it, and they're believing and hearing the narrative of this is the next great technological advancement. And again, it may be, but it may not. It's just not ready for prime time yet because a lot of work slop is getting created. So as this article points out, when you take the factors of what, from a number of scholars' research on this, what causes bubbles, uncertainty, pure play, a large number of novice investors, and a coordination or alignment of beliefs through narratives, the AI hype checks all the boxes. It has all the hallmarks of a bubble, and it hits all the right notes. And as they point out in this article, on a scale of 1 to 10, the current AI hype, where does it fit? It's a 10. The most likely short-term scenario is volatility, regardless whether AI plays out or not. I'm not here to argue that point. My point is simple. The risk exists regardless of what happens. What do I mean by that? It's real simple. If AI succeeds, it's probably going to quickly replace quite a few jobs, which will cause an unemployment crisis and an economic crisis, at least in the short term, with our economy. If AI fails, we'll see a stock market correction, even a crash that could become quite aggressive and quite fast, and that would be a very negative impact on a lot of people's portfolios, their retirements, their 401ks, and the economy. How do you manage that? You take risk off the table. Index products, like I stated earlier, have the ability to grow your money, unlimited upside, no downside risk. You can lock in your gains at any time, and you can reset at lower levels and make money on the way back up. But you do have several different options. I've been sharing this with a number of listeners who've reached out to me. I really appreciate that. I call it like option 1, option 2, option 3. We've got like 3 doors, right? The simplest one is the index annuities. If you're what I consider more of a passive investor, you put money away, basically let it sit, let it grow, supplement retirement, or you want to take an income off of it in the near future, either immediately or say in a year or more. Well, an index annuity is probably your best option because that money's going to grow, insured, with guarantees, tax favored, no downside market risk. I've access to over 600 different indexes, and we have the track record, the history, the 1, 5, 10-year history of what each of these indexes have done. The ranges are quite remarkable, as low as close to 0 and as high as 17% average annual return over the past 10 years. Obviously, I'll show you all of them so we can help pick some of which are the better options, which are going to give you the more upside potential growth with no downside risk. So if you're wanting to grow your money, let it sit and grow, supplement retirement, supplement income, an index annuity can be a great fit, and it's the best time in over 40 years to look at these products. If you're more of an active investor and you want liquidity, you want to have your money grow up to 17% average annual returns on some of these indexes, or you want to have the more steady eddy consistent where it grows every year no matter what, we have both of those options available. But with these are your personal bank policies that allow you to grow your money insured with guarantees, tax-free, and highly liquid, which gives you the ability to obtain positive arbitrage. So if you're more of an active investor, an entrepreneur, or somebody who's wanting to take money and look at investing it into other things or expand your business or that type of thing, your personal bank policies are probably the better choice because you can have access to 2/3 to 85% of your money literally within 30 days. And you can access that money to re-engage if the market corrects, or if you want to expand your business, or any number, or look at other assets you want to invest in and obtain that positive arbitrage. Now, many of my clients end up doing both because they have different buckets of money with different purposes. Maybe they have a retirement type of account or IRA, 401k even, and they want to continue to see the money grow if the market goes up, but they don't want to lose if it goes to the downside. Why? It's quite simple. Typical stock market cycles, when the market corrects, it takes 5 to 15 years for it to get back into even. The dot-com bubble, for example, if you were in the NASDAQ in 2000, took 15 years for you to get back to even, which means you made no money for 15 years, folks. If you were in the S&P 500 in 2008, it took 5.5 years for that money to get back to even, which means you made no money for 5.5 years. That's sort of the range. 5 to 15 years is the normal, typical cycle for when a market corrects for it to get back to where it was. Now, this one's gone up so far, so fast, it's likely that it could be in the longer end of that, but that remains to be seen. As I point out to people who are invested in the market right now, look, if you have 5 to 15 years to wait for it to come back, fine, stay where you're at. But if you don't, or you don't want to ride that potential roller coaster down and then have to wait and ride it back up, you have options. Door number 1, door number 2, door number 3. If you want more information, contact me at yourpersonalbank.com. Stay tuned in the next segment. I got one more thing that I think you're going to find about the AI hype bubble that you're going to find shocking if you haven't heard about this yet.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com. Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So here's another aspect about this current AI hype, extreme increase in asset valuations that I don't think a lot of people are really considering. And it has to do with not only the AI exuberance, but it has to do with reckless private credit and skyrocketing levels of sovereign debt, which is contributing to this economic bubble. You see, it's not just the AI bubble, but it's the debt combined with the two that increase the risk dramatically to this current speculative exuberance. I've shared on the show many times where the extreme valuations, the highest numbers we've ever seen in the history of the stock market, depending on how you want to measure it, we're about 50% higher, if not more, than the peak of the dot-com bubble, which was the previous highest asset valuations ever seen. 1929 was another period where asset valuations were extremely high levels. We're well above those as we speak. That's well known. Anyone paying attention understands this. But the other problem we have is non-bank private credit is now bigger than at any time ever recorded. As I've shared on the show before, I was the chairman of the board of an FDIC-insured bank in formation, so I'm very familiar with the banking industry. Most financial folks aren't. They don't have that history. It's not their fault. Those two areas of finance don't cross-pollinate very often. I've been blessed that I have had experience on both sides. Banks are highly regulated in terms of what they can lend money to, and they have to have a certain percentage of their assets in low-risk loans, what's called Tier 1 capital. They can have higher risk loans, but the bank regulators only allow a certain percentage of their assets to be invested or loaned out in these various range of high and low and medium and low risk loans. Non-bank private credit or private lenders do not have those same regulatory requirements. And a lot of the AI exuberance is being funded now by much of this non-bank private credit. But banks never want to miss out on a good party. Many of them have now lent about 10% of their total asset book or their loan book to intermediaries that then create non-bank private credit. If those loans were to fail, banks would have to write down a substantial part of their Tier 1 capital reserves, which is that's what buffers them against tough economic times. And why this is so concerning is non-bank private credit or private lending typically escapes regulators' attention. For private lenders and even banks who are engaged in this type of lending, at least indirectly, the interest is usually higher because if you can obtain traditional lending, go through the underwriting process, you usually can get lower interest rate loans. The reason why a business or individual borrows privately for private credit is, their credit or their collateral or whatever it is they may have to offer is not substantial enough to back the loan for traditional lending or traditional lending underwriting requirements. It's a higher risk loan, therefore a higher interest rate. I often share this when I'm educating people in the personal bank concept and using bank lines of credit to borrow against the cash of a policy, that these are fully collateralized loans, which is why you can borrow at prime or even below prime rates because it's one of the lowest risk loans a lender can offer. So you can borrow money at the cheapest rates you can get anywhere. By the way, if you don't know what prime rate is considered the lowest rate an individual or small business can borrow money at with good credit. So you can borrow at that or below even because you fully collateralize the loan with these personal bank policies. Most people understand a mortgage or a car loan, interest rates are lower than, say, a credit card loan. Why? It's real simple. If you fail to pay the lender back, they can take the house or the car. That's a collateralized loan. There's an asset they can take. A credit card, there's nothing to back it up. If you fail to pay the lender, obviously they can trash your credit score, but they can't take anything. So it's a much higher risk loan for the lender. That's why you typically have to pay a much higher interest rate. But generally speaking, private loans are higher interest rate loans than traditional bank lending is. Higher risk means a higher risk of failure, or which can contribute to this AI exuberance that we have. So it's not just the fact that stock prices and valuations have run through the stratosphere, but many of these companies are now borrowing to fund this infrastructure to try to build this out. And more companies are relying on private lending, which is not really regulated, is higher risk, and has a higher risk of default. This is the type of stuff that can not only create a economic bubble or a stock market bubble that then bursts, this could lead to an economic crash where there is a shortage of liquidity, lenders fail, banks struggle or fail, the Fed has to bail them out. If you remember, we had a company named Lehman Brothers, which had been around for over 150 years, that had been investing very aggressively in credit default swaps, which were a sophisticated investment tool with a high degree of leverage and risk. Well, when things failed, there was a lot of money being borrowed. That was a trigger that started the Great Recession as we know it today. We are in a similar situation as we were then in terms of debt with private lending. And then we also have the additional challenge today that we did not have in 2008, and that's high levels of sovereign debt or government debt. And it's not just the United States, but most Western countries around the world have much, much higher levels of debt than they had back then. And if you remember, there were a number of bailouts that occurred in 08, 09, starting with the first TARP. When the government has such excessive levels of debt, it has far fewer options to be able to deal with an economic crisis. So in my opinion, the risk is higher of a bubble bursting today than it was even in 08, 09, or going back to the dot-com bubble in terms of economic devastation. Whether AI succeeds or fails, we have an economic challenge ahead of us that could easily lead to either recession from AI succeeding and replacing a lot of jobs fairly quickly, which would drive unemployment up, which would likely lead to a recession, or the other scenario where AI fails to deliver as promised, investors get frustrated, and we see more of a dot-com type of correction, frankly, crash. Markets crash, which would also lead to a lot of economic devastation. Look, I'm not here to give you tons of bad news. I want you to be aware of the risk that is really there and what's involved. It's just like I've been discussing with a lot of people recently who are out there trading options. I find it shocking how often someone shares that with me, and I start asking them some questions. Are they aware of the risk that they're taking? Because not only, buying a stock can go down in value, but an option also expires in time. So not only do you have to choose the right direction, but you also have to choose the right time frame, or that option can go to zero if you're buying a call or put option, for example. And it amazes me how often people truly do not understand the level of risk that they're taking when they're making those types of investments. I've even run into folks who are doing things like that with leverage on top of it, which means they're borrowing money, doing things on margin. I mean, if you want to talk about like your risk tolerance level, going from a 0 to 10, you're maxing that dial out to like 11, folks, when you're doing options or leverage and that type of thing. Here's a great analogy. We all know when you drive a car, there's a tachometer on there. You see a red line. There's how many RPMs the engine can go up to. And we all know that you don't want to go up or past that red line because, well, bad things can happen. The engine can fail. You sometimes in an emergency could probably push it up there, even maybe a little bit over, and not have any long-term damaging effects. But if you start doing that over and over again repeatedly, what's going to happen to the engine of that vehicle? One of those times it's just going to fail, and it's going to blow up, and you're going to have smoke all over the place, and then you're going to have a dead engine. I'm running into so many people, and again, this is deja vu. I've been on this ride before. I saw this in 99, where people were pushing it to the limit because things have been so good for so long, and then the engine blew. I don't know when the engine's going to blow. Every indication is pointing out, more and more increasingly believe that we're going to see something go in the economy, the markets, whatever that may be, whatever the cause is. And a lot of people are going to get caught and going to get burned because they've committed too much, or they leveraged too much, or they thought, hey, it can't, it's not going to go, This time is different. All those things we hear all the time, every time we see a previous cycle, like I saw in 2000, like I saw in '08, we heard all the same types of things then. To finish this thought on this article, they're comparing a number of previous booms and bust cycles that we had. But the point they're making here is the core of this bubble is now non-bank credit, not the banks. And non-bank credit or private lending has replaced banks as the financiers of excess. And we have very few details of where the liabilities are really located. And this means, this is their conclusion, that the economic and not just financial credit machine that will be in the crosshairs of any crisis. They believe the credit, the private credit that's out there with this AI hype could be the determining factor of whether we have a correction versus a catastrophic outcome economically. The risk is there, folks. Do what the professionals do. Take risk off the table. Index products, as I stated earlier, allow unlimited upside gains with no downside loss. The principal is guaranteed. You can lock in the gains at any time you want. Over 600 indexes available with the 1, 5, 10-year history of those. We have indexes that have literally averaged over the past decade upwards of 17% annually. Many people who have index products, whether it be annuities, life, whatever, may even have a good product with a good company but are invested in the wrong indexes. If you don't have the historicals on what these indexes have done, you're flying blind. So is the agent or the advisor that recommended this. Yes, they can make some educated guesses, but the reality is, unless you have access to this proprietary information, which very few do, it's a game changer, folks. I can share that with you and show where you can likely increase the upside potential returns of your index products significantly, many times 2, 3, and 4-fold more. If you want more information, contact me at yourpersonalbank.com. Stay tuned in the last segment. I have some information that almost nobody that I've seen has discussed and will blow your socks off regarding AI investments. Don't miss this.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of the Your Personal Bank Show. Great news! Most insurance companies have announced higher dividends for 2025. They also reduced fees. This will increase cash growth even more than before. This is the best time in over 40 years to consider a high cash value dividend-paying policy. Also, dividends are expected to increase for the next several years. Contact me at Your Personal Bank or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Well, I have some information here that, if you have not heard about this, should blow your socks off regarding the AI investment hype and etc. It turns out OpenAI recently has requested financial support from the U.S. government for its expansion. This is according to Bloomberg. OpenAI wants taxpayers to guarantee its debt. They're asking for the government to guarantee their loans, like a cosigner. Now, when private companies start asking for public funds, that's typically a sign that things are not going real well. They obviously have some concerns. If they didn't have concerns, if OpenAI was just moving along just fine and was able to obtain the financing they needed to expand, and they would not need to be asking the government, the taxpayers, to back their loans. This is very, very concerning news, and my hope is that the current administration turns them down. I do not see any reason why the U.S. taxpayer should be on the hook for OpenAI's debt. To me, it's beyond ridiculous. We'll see what happens. And another point that I think is super valid, Warren Buffett doesn't say a lot that often, so you have to watch what he does. Well, guess how much Berkshire Hathaway cash is sitting on? over $382 billion. And I shared last week that with that cash pile, do you realize Berkshire Hathaway could literally purchase 474 of the Fortune 500 companies? Berkshire Hathaway could literally purchase almost the entire S&P 500 index currently have, or actually it's U.S. Treasury bills that they hold primarily. Well, that tells us two major factors, and I had a listener contact me about this, and I thought this was a really great question. First of all, why is Berkshire Hathaway, Warren Buffett, not purchasing a bunch of the S&P 500? Obviously, because they don't feel like it's a good deal. It's overpriced. I think that one's quite obvious. The second point is, the listener asked me, is what is the cash in? Well, predominantly it's in U.S. Treasury bonds or Treasury bills. Well, that tells you Warren Buffett's faith in the U.S. government and the U.S. dollar. Granted, the value of the dollar has diminished, particularly with inflation and money printing. No question about it. But if you compare where the U.S. dollar is at and the level of printing and inflation and et cetera, and the economic situation, say, to other countries around the world, theirs, for the most part, is worse, oftentimes much worse. China's economy certainly is not doing better. They have a lot of trouble with real estate in particular and a dwindling population because they had a one-child China policy for upwards of over 3 decades, I believe. The demographics of that is devastating for their economy going forward. Europe's not doing any better. They're far worse. And in fact, they have much more debt relative to the U.S. in terms of GDP. So when you start thinking about places to invest your money, where are you going to go? Well, as bad as the U.S. is, it's still better than pretty much almost any other options. And Warren Buffett himself, through his actions, is backing that up with over $380 billion in T-bills. Berkshire Hathaway owns a lot of U.S. Treasury, which means they have a lot of faith in the U.S. dollar. And Warren Buffett has been called the Oracle of Omaha for a reason, one of the best investors in history. So although, yes, our economy has problems, the U.S. dollar has problems, but not near as much as many of the other currencies today, and still probably one of the best places to invest is the U.S. economy. Some other concerns, though, that come up is Microsoft CEO recently stated the company doesn't have enough electricity to install all the AI GPUs in its inventory. In other words, they own a bunch of computer chips, but they don't have the power to run them all. He said, and I quote, "You may actually have a bunch of chips sitting in inventory I can't plug in." That is becoming increasingly a bigger and bigger problem, which is why Goldman Sachs and Morgan Stanley recently warned of a market correction. As they put it, things run and then they pull back. And Michael Burry, he was the investor that was famous during the Big Short, where he shorted mortgage-backed securities prior to the Great Recession, famously, and most people thought he was crazy for doing so at the time, but it turns out he was right in a big, big way. Well, Michael Burry now warns of a AI bubble and makes a huge bearish bet on NVIDIA and Palantir, because as he puts it, the valuations are now ridiculous. It's hard to argue with Michael Burry when you look at Palantir, for example, that has a PE ratio of 646. What does that mean? It means it'll take 646 years of full current annual earnings to recover your investment. As they point out, there's no room for a hiccup. Otherwise, it's the guillotine. A PE ratio of 30 is considered extreme. Palantir's is at 646. Think about that a minute. And this is why a CNBC article pointed out, after years of outsized stock market returns, it's time to reassess your portfolio risk exposure, as many top advisors are stating. Modern portfolio theory teaches you should have a mix of equities and bonds, or equities, assets that are subject to market upside, and some that are more safe. Typically, they recommend bonds, but frankly, annuities can fit into that category too, or fixed assets, I should say. And today's annuities are so much better, you can actually use them in lieu of equities because they do have unlimited upside gains with no downside risk. But even if you're doing the traditional modern portfolio theory, the point they're making is if you had a 60-40 split, as many of us heard, because the equities or the stocks have gone up so much in the last few years, your ratio is probably all out of whack if you haven't adjusted recently, and you probably should readjust to reduce your risk. If that is the case and you're needing to pull back on some of that risk, consider an index product because those can accomplish that goal for you too while still giving you significant upside gains. It's kind of the best of both worlds, if you know what I'm trying to say. We're dealing with a lot of economic challenges. There's a lot of waste and fraud in government spending. It's spending far too much. We have an AI hype bubble that increasingly looks like it will burst, and unfortunately could burst quite badly, which would be an economic devastating event, create a significant amount of volatility. AI does succeed and lives up to its billing. It likely would take away a lot of jobs, which would increase unemployment, which also would have devastating economic impacts. Look, there's a lot of problems, but there are some simple solutions to much of these things, and you can protect yourself from the volatility of it all. Reduce your market risk, scale back risk. Index products offer unlimited upside gains with no downside risk. You can lock in gains at any time. Over 600 indexes available. We have indexes that have up to 17% average annual returns over the past decade. I can show you the actual returns of these indexes. This is game-changing, folks. And if somebody doesn't have this data, and it is proprietary, so most don't, you're kind of flying blind. So if you have an index product, whether it be an annuity, life product, whatever it may be, contact me at yourpersonalbank.com. I'll show you better indexes to increase your returns, oftentimes 2, 3, 4-fold. If you haven't looked into this or you want to look into this and reduce your market risk, yet maximize your returns at the same time, contact me at yourpersonalbank.com. Stay tuned next week for more great information on the Your Personal Bank Show. And as long as it's on our money, in God we trust.
This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states.
Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.